Welcome to Stifel's Investment Strategy Brief, a monthly recap of the macroeconomic and market environment. Well, greetings and welcome to the June 2025 Investment Strategy Brief podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this session, this episode, I want to get into the idea that the markets have proven to be kind of resilient, even with existing and growing tensions with a variety of things, certainly policy in DC, geopolitics, etc. So we're going to jump into that in some detail. And I really want to start with geopolitics. Just over the last week or so, my team has released an updated version of what we call our geopolitical dashboard. So think of it as a process we go through to identify risks of things happening or potentially to happen all around the world. So you might think of, risk to the U.S. dollar as a reserve currency, or is there going to be a strain from an aging population, or is there a risk of cyber attacks? And one big one that we talk a lot about is U.S.-China competition that's basically in place, right? And things that happen both around just pure sort of fair competition, and then some of the misbehavior potentially that happens as a result of the two countries wanting to fight it out. But today I want to dig in on one risk that we described as likely, and unfortunately it may be coming into play here. Really, the concept of a war, a sustained war in the Middle East. And so obviously, it's actually just last night or overnight last night, we had Israel launch a pretty major missile attack on Iran with an indication that it is going to go on for a while. And I wanted to dig into a little bit of the context of what's been going on. So it really relates to Iran, among other things, Iran's nuclear program and things that have happened and not happened over the years as it relates to that. If we take it back to 1968, when Iran signs this broad agreement, the Nuclear Non-Proliferation Treaty, the NPT, the signatories agreed to not pursue nuclear weapons, basically. And it was discovered years later, 2002, that Iran had some secret nuclear sites, sparking some concern. In 2015, Iran signs the JCPOA, another nuclear deal, and agrees to limit its nuclear program in exchange for some relief. But then in 2018, back then in his first term, President Trump withdraws from that agreement, and that sort of gave Iran some reason to scale back compliance. In any event, when we look into 2025, basically there's been renewed tensions and an escalation this year. So actually, we go back a few months, the U.S. and Iran has actually been in talks around the nuclear issue. And then in May, what's called the International Atomic Energy Agency, the IAEA, that's the UN's nuclear watchdog, reported that Iran had a lot of enriched uranium, enriched to quote unquote 60%, so close to weapons grade. And so then in June, that same organization declared Iran non-compliant for the first time in 20 years. So interestingly, Iran got aggressive and basically announced and launched a new enrichment site, including installing advanced centrifuges. So Iran's kind of calling everybody's bluff. Now, as it relates to Israel, for a long time, there was sort of a desire for diplomacy and keeping the region stable as the deterrence to actual military attacks and military conflict. That obviously changed in the region with the Hamas attacks in 2023. And, this is all against this backdrop that Israel has long seen Iran as an existential threat when it comes to the potential for nuclear trouble. And so along the way then, anyway, think of it as, again, with the U.S. a little bit involved, a new deal was in the works to limit Iran's nuclear program. But the punchline here is that basically, again, just over the last night as I record this, essentially Israel launched strikes on Iran's nuclear facilities and other military targets. Prime Minister Netanyahu has vowed that the operation will continue as long as it takes. And the idea is they want to cripple enrichment efforts and disrupt the leadership around that and weaken their defenses. Now, there has been an attempt by Iran to retaliate. I don't think any of the drones or missiles that might have been launched have reached Israel at this point. But obviously things are really escalating and have escalated. And so that idea of a Middle East war seems to be, a sustained war seems to be a strong possibility at this point. So obviously we're watching the circumstance very, very, very closely. Now that's against the backdrop, just to take it back to our more normal topics of changes in D.C., where we've talked about tariffs and trade policy, the tax bill, the spending bill that's making its way through Congress, the Health and Human Services changes in Department of Education and with immigration, and the Department of Government Efficiency. Now, with regard to DOGE, the expected savings have been scaled back quite significantly. The current number is around $180 billion. And much of that, by the way, savings in Health and Human Services. But another sort of point of note is the idea that Elon Musk, who is very involved in DOGE and very much engaged with President Trump, basically has stepped away. And there's been a bit of a feud between Musk and Trump, a little bit over the spending bill, where I think Elon Musk thinks it shouldn't be so large, right? He's obviously part of his motivation for getting involved was the idea of sort of cutting back on spending. So with all that to say, the uncertainty of the changes in the administration has had us talking, even in our last session or two, about basically an erosion of animal spirits. So policy shifts, sometimes erratic, aggressive, and sometimes poor communication, all triggering kind of people being less confident. And that can be individual spending potentially, or businesses spending. And, there's a risk that turns us all towards a recession. There's a chance that we have still inflation. So therefore, if a recession occurs, stagflation. So those were the negative scenarios we've been talking about. And there was a little bit of a sort of a bear case scare in the first, as we progressed into 2025, but that's reversed. Now, I do want to point out that the environment seems to be one where we're, kind of moving back, not towards a full positive bull case scenario, but where participants are maybe hoping and expecting trade deals to happen. They're refocusing back on maybe the benefits of lower taxes and on deregulation. So markets in general have moved higher, and data is signaling concerns are softening a little bit. Now, as it relates to the environment, just to turn to the economy, we've seen the economy slow a little bit. There was a technical sort of decline in the first quarter, or more around a jump in imports because of the tariffs. But when we look at things like consumer confidence and sentiment, we see a recent uptick that people are not quite as concerned. That's corresponded, by the way, with decent retail sales activity against an environment where individuals are paying higher levels on their debt. But still, think of it as consumer activity remaining pretty positive. Labor market remains relatively firm. And so that's, supportive of the environment. We also, by the way, saw an uptick in business confidence, basically. Again, I think around some of the trade deals being announced and so forth. But with all that said, punchline on the economy has been that most experts have brought down their forecast for 2025. And so while most are not anticipating a recession, that's something that has been in focus. Now, we're blessed to have our chief economist, Dr. Lindsay Piegza, doing a lot of work, and her forecasts have come down as well. She has shared with us a lot of interesting analysis around the potential for impact of tariffs on consumers as it relates to things like food and trade more broadly. And so everyone's kind of watching for the potential for tariffs to influence inflation, but candidly, hasn't happened yet. The last couple of prints of the consumer price index and the producer price index were pretty muted. And honestly, I just penned an article that's indicated that, when we look at the last 4 months, these are the 4 months through May for PPI and CPI, the numbers are at or often below the monthly equivalent on average, or if we annualize the number, the annual level of the Fed's 2% target. And so the punchline is, for the last third of a year, we've had muted inflation, with everybody worried that tariffs are going to kick it back up. So what does that mean for the Fed? Well, the Fed basically, if we go back to, let's say, the end of April, the market was pricing in four quarter point cuts on the Fed funds rate. That's been reduced to 2 and extended to not start until September. So the Fed is signaling around this sort of work on their dual mandate, trying to keep the labor market strong and stable prices in place. And again, the idea with that is to bring inflation back down. Fed feels confident and maybe thinks it's necessary to keep policy where it is. They keep talking about that, really with an eye towards that labor is held up, and we want to see more evidence that inflation will stay under control in a sustained way. Now, speaking of the Fed, I just do want to point out that we're blessed as well to have Brian Gardner, that's Stifel's chief Washington policy strategist, and he's covers, among other things, the Federal Reserve, that a bit of going on in D.C. And I did want to make note that, Jerome Powell's term as chairman is up in the middle of next year. And so there are two candidates being considered. One is Scott Bessent, and the other is Kevin Warsh. And with Bessent, a Trump ally for sure, lots of experience in the industry and a very positive reputation. He's someone who, even as Secretary of Treasury, so the Treasury Secretary, is very focused on, the deficit and the budget, and understands the need to rein things in a little bit. And so he's one candidate. And then former Fed Governor Kevin Warsh, is highly regarded and is also a candidate. So just wanted to mention that. In any event, turning then to this idea that we see debt really has risen since the great financial crisis, that remains in focus. We've talked about it many times before, but increasingly more and more leaders are talking about the need to rein in the deficit and to rein in the debt. And that is something that will remain in keen focus. Now, as it relates to the markets, interest rates have been volatile. They've gone up a little bit. They've come down a little bit. The 10-year is sitting at about 4.4%, 10-year Treasury yield. So rates look attractive when it comes to being an investor to put money into work in bonds. And on the equity side, while we've had a lot of volatility in 2025 and a big drawdown really around Liberation Day and the tariffs, things have really recovered as that sense of confidence has come back a little bit. And we're back to a point where year to date, things are positive. When we strike the level of the S&P 500, we hit this level approximately back in early December of last year. So while some volatility this year, markets were pretty elevated then, and we're back to that level. In fact, on a cap-weighted PE basis, the markets are a little bit overvalued, trading to about a 17 to 18% premium on a 10-year average PE. But when we look at an equal-weighted basis, things are much more normalized. Think of it as maybe a 1% premium. So again, markets have run up a little bit. that with that drawdown in the market and then the recovery on a year-to-date basis, for example, the S&P 500 is up 3.4%. The other thing I would mention is non-U.S. stocks. So the developed markets, for example, the MSCI EFA index is up almost 19% year-to-date. So a little bit around weakening dollar and a little bit around just the non-U.S. markets doing a little bit better. And so, again, even though we're not quite back to the peak, the market record, if you will, when the troubles started to occur earlier this year, the markets have really recovered some. And one of the things we talk about is how each calendar year there's a full year return that's booked about 2/3 of the time, maybe a little more. Those bars, those year returns tend to be positive, but in any given year, there's drawdowns. And so think of it as during the year, the market falls from its height. So for example, in 2025, that peak to trough move was 19%. It was down 19%. And yet on a year-to-date basis, we're up, again, about, in round numbers, 3%. So 3.4%. One final comment I'd say, just in terms of our outlook, we continue to anchor a lot of our work on our long-term themes around how things are shifting, that productive competition I mentioned between the U.S. and China, for example, and the shifts in demographics that are happening with global changes, how consumption's changing, how we need to be mindful of strategic resources like food and water and oil, which, oil obviously in focus with these tensions in the Middle East, and then the fourth industrial revolution around technology and innovation. And in some ways within that theme and beyond that theme is artificial intelligence. So all in focus. Hey, I'm going to close out by just reminding folks to check out stiefelinsights.com. And we really do appreciate you taking the time to listen to this session, and we'll catch you next month. Thanks so much.
Thanks for listening to Stiefel's Investment Strategy Brief. Be sure to subscribe wherever you're listening to automatically receive each month's podcast in your feed.